Welcome to Reality Check. During the 2008 election and last summer when gas prices were high and oil prices were high and gasoline prices were high, all of our candidates talked about how we needed to tax big oil. Well, one thing is certain, the federal government doesn't slow down when it gets started on some of these issues. And even though the price at the pump has gone down and our home heating bills may have gone down and air conditioning is less costly, the federal government is still moving forward to tax the industry. I'm Richard Loomis, CEO of World Energy.
And I'm Jim Puplava, president of PFS Group, joining you from the San Diego Daily Transcript.
Well, Jim, I've been looking over some of these proposals. The idea of the repeal of the manufacturing tax deduction for oil and gas producers, the repeal of the percentage of depletion for oil and gas, the excise tax on Gulf of Mexico oil and gas, repeal of expensing of intangible drilling costs, and the list goes on. Just what are they trying to do?
You know, this is rather remarkable, Richard. When I saw the list and the report in terms of what they're trying to do, a lot of people were upset about the big energy companies, and especially last year when we got to summer and prices at the pump were close to almost $5 here in California. But since then, we've seen a precipitous drop in the price of oil. We're now talking about prices in the mid-40s. Prices at the pump, as you mentioned, have dropped, well, here in California, we're about $2.50 for our barrel or a gallon of premium. But what they're doing is, instead of going after the big companies, the tax proposals, and I got a list here, the 10 that you were talking about, we're looking at going after the small companies. And these are the companies that, you know, these are small producers. These aren't the large integrated international oil companies. These are the guys that go after the small fields. But what's rather remarkable is they account for almost 7 or 8% of our natural gas production, and they account for almost 8 to 10% of our oil production.
Yeah, and I know, I'm looking at these, like even just the first one that I mentioned, the manufacturing tax. Manufacturers get a 9% tax break. In the oil and gas business, it was 6%, and it didn't apply to the majors. But it did allow us to do some marginal projects as the price was escalating last year. And the price coming back down again, if you start to take away any kind of breaks the industry gets, well, it just raises the bar. It makes something that would have been economical at $50 need $60.
What makes this more significant, Richard, is the cost in the industry have not fallen to the same extent that you've seen the price of their product fall. So you're still talking about very expensive costs for labor, health care, raw materials. We've seen this year already the price of copper is up, the price of iron ore is up. So margins have been squeezed in the industry. Now, if you take the large players in the industry, the large integrated oil companies that run everything from petrochemical complexes to upstream development, they have the diversity in terms of oil fields and how their diversification of their product mix, and they also have the capital structure. Many of these companies are sitting on 10, 20, 30, $40 billion worth of cash, where the small independent producer not only has trouble in getting access to credit, but now you're talking about, with costs still rising, the product or the price of the product that they sell is falling. Now you're talking about taking away some of the tax benefits. And Richard, I want to go to one that is really an industry killer, which would be intangible drilling cost. I wonder if we might spend some time talking about that.
Well, in intangible drilling costs, I mean, what we're talking about are repairs, we're talking wages, we're talking costs that are very, very difficult to get a handle on to begin with. And since the very beginning of the oil and gas industry, we've been able to use this one. If you take that away, then these costs have to be just like any other capital expenditure, and they have to go over the life of the well and depreciation, basically just raising the cost. On a big find that the majors would go after, this really isn't an issue. But when you're dealing with stripper wells, this is a really big issue. And most of the mom and pops, the smaller independents, are not dealing with massive offshore projects. We're dealing with small wells, and we're dealing with 1, 2, and 3 drilling programs. This really does hurt at that level. And you're right, these are where the jobs are. This is where wealth is created for the small business owners. And this tax would be targeted directly at them. It's interesting, coming into last year when we were talking about taxing big oil, if that was the goal, none of these proposals really target that type of company.
Now, and what is rather significant is these intangible drilling costs have been around since 1913. And for our listeners, let's say that you're an oil company and you spend $1 million on drilling a well. Well, you know, you are with IDC, you're able to take that off as a deduction against your revenues. If you're not able to deduct that and depreciate it over a 10, 20-year period of time, you're talking about paying tax on $1 million that you spent on intangible drilling cost and depreciating it over a 10-year period. And for a lot of these companies where the margins are being squeezed right now because of the cost of the product, developing that product, and then at the same time with revenue cost coming down or revenues coming down in terms of the price of the product, you're really talking about squeezing these companies and putting them out of business. What is also rather significant about this too is, and I want to move to an egregious tax proposal, and that's the repeal of the percentage of depletion for oil and gas, because when you find oil and you produce it, you are using a valuable resource. So you were able to take a percentage of what it was you got in sales as a write-off, because what you're basically doing, you're consuming a product that you produce. You produce it, you take it out of the well, that means there's less left in that well to produce, and so you're consuming a resource in your production process. And I thought repeal of the percentage depletion for these small companies, that's another company killer as well.
And you start looking at where these things go. I mean, there was widely reported when they were talking about trying to fix the excise tax in the Gulf of Mexico. But that really doesn't affect these companies because most of them were on the appropriate excise already. And that one made the press. The rest of these really erode an industry which only accounts for about 30% of our consumption. I mean, we're importing 2/3 of our oil. So if you start to attack the industry that's giving us 1/3, you're basically saying we'd rather just send those dollars overseas and let these other countries provide us with that oil. And that just doesn't make sense, particularly at a time when our own economy is weak. Why would you go after one of our only bright points, being our domestic energy producers, particularly the independents?
Well, let's take this to the next step. Okay, the purpose of raising taxes is the government's looking for more revenues. There's about 420,000 stripper wells in this country. If you get rid of the percentage depletion, if you get rid of, which is significant, then you're talking about a shutdown of a stripper well. And Richard, once you shut down a stripper well, you have to remove all the infrastructure that's around that well in terms of its production. So now, once you shut that well down, you run into a situation with, are you going to be able to bring that well back online? And unless prices rise to a significant nature, you're not going to bring that well back on. So this happened in the 80s where we shut down a lot of our stripper wells, and many of those wells were never brought online.
Just for definition purposes, a stripper well only produces, what, 5, 10 barrels a day?
Yeah, it's a very, very small well, but you know what? There's 420,000 of them in the United States. If you live in California and you're driving on Highway 5 through Kern County, you can see many of these old grasshoppers off the side of the freeway, and that's what they're doing. They're producing between 5-10 barrels a day. May not sound like much, but when you get enough of them, 420,000, it accounts for almost 8 to 10% of the production of oil and natural gas in the United States. So taken collectively, that becomes rather significant. And here's the thing that, somebody needs to give these guys a calculator, because if you start shutting down these wells, because they're no longer profitable, you don't get the percentage depletion, you don't get the intangible drilling cost, then what happens when you shut down these wells, Richard? You're no longer producing oil and gas revenues, which means the government is not going to get any taxes. So, here they are trying to talk about raising money, But what they're doing, the policies are designed to shut down a good portion of the industry. Therefore, when you start shutting these wells down, less revenues, less taxes to the government.
Well, and as the price dropped in the 80s, I mean, we saw people leave this industry in droves. During this last price uptick, I think we were starting to attract more people in. If you create an environment where we can't even afford to do our very small wells, you're really not going to bring more people into the business. If that's the case, we could see our own domestic oil production drop to, what do you think, 20%, 12%? And the rest of these dollars leave the country.
Probably 15 to 20%. And I want to move on to another topic here, which is what has happened. Everybody's been talking about demand destruction, but what we're not looking at is what is going on with the supply side. And I'm looking at a report here that's talking about a drop in the rig count, Richard, that will be down about 70% this year from its peak from last year. And it's rather interesting because if you take the peak oil camp, you've got guys like Matt Simmons who are probably early peakers, and then you've got people like Daniel Yergin from Sarah, who is more on, well, we don't have to worry about this for another couple decades. And I'm looking at a report here from Sarah that just came out recently, and they're talking about between the years 2012 and 2014, you're talking about as a result of all these projects that are being taken offline, you're talking about a shortfall of 7.6 million barrels a day of needed production. Sarah was projecting that we were going to need somewhere in the neighborhood of about 100 million barrels a day from all sources, whether conventional crude or alternative forms of energy like deep water, tar sands, coal to liquids, gas to liquids. And they're talking about a shortfall of 7.6 million barrels. And they're looking at almost a crisis window without saying it directly. And what is amazing, this lines up with the IEA report that came out last November, where they talked about after looking at the 800 largest oil fields in the world, the depletion rate was much greater than what they thought. And then the supply or the excess capacity within mainly OPEC would be shrinking at a time. And here are the Sarah folks, which are basically been probably the more optimistic out of the group, issuing a warning that if this trend continues, if prices don't go back up, you've got John S. Harold talking about an 18% reduction in upstream exploration cost for 2009. So at a time, governments are trying to get their economies to grow. The industry itself is contracting because of not wanting to spend the money at a time that profit margins are being squeezed. The availability of credit is being denied to many of these companies. And then on top of that, we're trying to add additional taxes on our small independents that would take additional production of oil and gas offline. So it's almost like we're creating a perfect storm. And what is even more significant here is not so much what is going on in this country in terms of demand, but what is going on in the developing world where demand, which goes up at the margin, really determines what happens to cost.
Well, it's the last barrel that drives the cost, you're right. I think it's particularly interesting when you look at what Matt Simmons was warning us about, which is we would see declines and demand would continue to rise. Now we have Dan Yergin saying we're going to have a shortfall. So they both ended up on the same page, just from completely different paths. I mean, Yergin has always said we'd have the undulating plateau. And as prices go up, we'd be able to bring on more supply. As the prices are down now, we're pulling supply back. If you add on top of that some of our own domestic tax regime, I mean, you're going to raise the bar. So you're going to see more and more production pulled back and less put back into play. If our demand does increase, then you get both Dan Yergin's prediction, which is we're going to have this shortage, and Matt's prediction, which is we're not going to be able to increase production. So in essence, we would reach peak oil by default.
Well, you know, here's an interesting statistic. Even though last year we had a real good year for the first 6 months of the year, we saw oil prices go up to 147. But once oil prices peaked and we saw that 74% drop, the deal flow around the world dropped as well. But it's interesting, in the latest John S. Herald report, the only one, or the only group that is doing deals around the world are the sovereign wealth funds and the national oil companies. They see this as an opportunity. They see prices down in the $40 and $50 range, and they look at this as one of the opportunities of a lifetime to pick up assets around the world, because they know what's going to happen in the next decade. They know what the depletion story is. They know what the demand story is going to be in the developing world. So at a time that Western countries are pulling back, enacting policies that would penalize oil companies, the national oil companies from China to India to the Middle East are going on an acquisition binge, buying companies. China has spent over $50 billion in buying energy assets. They've invested $25 billion in Russia, taking 300,000 barrels off the table here for the next 2 decades. They're investing almost over $8 billion in Venezuela. They will take more of Venezuela's oil production. They're doing the same thing in Africa.
Well, Canada too. Don't forget about Canada. China is up there in a big way.
Oh, they're all over. They're in Africa, they're in South America, they're in the Middle East, they're in Russia. Any place where you can find large deposits of oil, China's government is giving low interest rate loans to their oil companies, and the directive given to their energy companies, rather than penalize them and try to punish them, they're saying go out and grab and lock up these resources, because we're going to need them to develop our economy in the next decade. We're going in the opposite direction.
Well, and not just China. I mean, recently I was speaking with the president of Statoil here in Houston, and they're actively pursuing assets here in the Gulf of Mexico, and they're deploying technology that's not. It costs too much to deploy this technology at these prices, but they're doing it anyway. And they're doing it to increase recovery rates. He was showing me some of the fields in the North Sea where they're investing millions of dollars in what they call IOR, increased oil recovery, where they're going to take a field that was producing about 30% recovery up to 70%. Long term, they see that as the key to being successful here in the Gulf of Mexico. Get a hold of these assets now when the prices are down, deploy technology that would be cost prohibitive, and take much more out of the ground long term. But of course, they're an NOC. They're a privatized national oil company out of Western Europe, Norway. They have a very different attitude toward these resources than we do. We're looking at an industry and saying, okay, let me tie one hand behind your back, let me attach your foot, and let's see how well you can hop so that I can take the money out of your back pocket.
Well, it's also, too, when you take a look at these national oil companies, oil is a long-term investment. When you take a look at acquiring a lease, getting your permits, setting up your drill program, developing it, and to the time you take it from, a greenfield discovery to all the way to production, Richard, that's a 7 to 10 year process.
Yeah.
So a lot of these national oil companies, such as China, Statoil, and many of these others are taking a look at, and they're saying, all right, what are our costs? Part of the cost is acquisition cost, your lease costs. And what they're doing is saying, look, while prices are low, lease prices are low, we can lock up these assets at a very, very low price, which means that if our technology costs go up, if our labor costs go up, our material costs go up, at least we can control one aspect of the project by going in and buying at a low price. In the western part of the world, we're doing just the opposite. Instead of encouraging our companies while the price is low, what is happening is they're having difficulty getting credit.
Yep.
Their costs are still high. The prices are low. And then we're talking about several things that we're going to do. You're only looking at one aspect, which is the 2010 tax increases in the Obama budget. Also on the horizon is $2 trillion worth of tax on energy consumption that's going to be placed on the industry with the cap and trade. Now, I wonder if we might move on to that, because it doesn't stop with the $33 billion in taxes on the independents. You're also talking about $2 trillion of new taxes. In fact, in the 2010 Obama budget, they talk about 2012, where the government would start taking in what they call anywhere from $80 billion to anywhere to $170 billion in what they call climate revenues, which is a reference to the cap and trade bill.
Well, I think we're going to get into cap and trade in our next show. But before we leave this topic, I want to come back to the thing you mentioned earlier, the perfect storm. If we buy into the fact that we are 97% hydrocarbon for transportation, and if we are importing currently 2/3, it would seem to me that we ought to be looking at policies that would increase our production domestically. And that isn't what we're doing. We're actually trying to stifle that production. If we go in now and we say, all right, with these taxes, with the lower price environment, and of course the coming tax on consumption, we should see the prices come back up again. These companies, I think, are going to get caught because those that do have production coming online or have production currently and cannot afford to go out and explore for more are going to see a lot of cash coming into their balance sheets as these prices go up as demand increases. I wonder what the Obama administration is going to do when they're pointing at cash balances within the industry when they can't get credit to extend themselves into these very expensive drilling programs. Do you think the Obama administration goes after those cash balances?
Well, here's a rather interesting statistic. Unlike the mining industry, one of the periods of time where you see the greatest consolidation in the industry is not when the price of oil is rising as it was between, let's say, 2005 to 2008. Most of the consolidation in the industry occurs when the price falls. And I want to go back, and I'm just looking at a recent report here, Richard, where if you take a look at the last down cycle, which was in 1998, where oil prices fell 30% that year, they fell from $26 to $18 a barrel. The industry was somewhat nervous, as it had a right to be, but then they fell another 20%, and you had the price of oil go all the way down to $11. Now, what happened during that period of time? You had British Petroleum buy Amoco, Exxon buy Mobil. You had BP come back and buy Arco. Total bought Elf. Chevron bought Texaco. So it is during these periods of time where the assets of a lot of these oil companies are so discounted at a low price, and certainly we saw that last year in the third and fourth quarter, where you saw independent oil companies see their stock prices fall by as much as 70%. Even the large integrateds had price declines of 40 and 50%. Then we had another wave where you had Chevron buy Texaco, Phillips buy Conoco, Chevron buy Unico, Unical that is, and Anadarko buy KMG, Statoil buy Norsk. So look, I believe that, when you take a look at the large integrated oil companies, instead of going out and expanding their budget, I think a lot of them are sitting with cash on the balance sheet and saying that probably the best investment they can make right now is go out and buy existing reserves in the ground. There's less risk to it, and it's accretive to earnings and also to the reserves of the company. And I think that's what you're going to see, Richard, is another wave of consolidations. And a lot of these independents are going to go, because their assets are selling at such discounted prices, some of them with having difficulty getting access to credit, whether the takeover offers are friendly or they're hostile. I think you're going to see another wave of acquisitions as a result of these falling stock prices and falling price of energy itself.
Well, we're starting to see it already. You got Petro-Canada and Suncor that are trying to get together up in the Canadian tar sands. We've got other companies down here that are actively out shopping. But I just wonder what happens as they start to consolidate, because these bigger and bigger companies are not, they don't do very well when you have high-priced oil, because they can't move very quickly. And they need very big projects to make the economics work. On the upside, Fortune 500 says that ExxonMobil is the most profitable or the biggest company we got. They beat out Walmart. And then right behind them, you've got Chevron and Conoco.
Well, it's going to be amazing, because you know what you really need and what this country needs, it's really those small independent producers that are going to make the investments to go into a small oil and gas field, If they can get a couple thousand barrel a day project going out of a well, that's worthwhile for a small independent company. Somebody like Exxon, they're not going to look at something unless it's an elephant of sufficient size. If Exxon's going to look at something, they'll look at either a large oil field like they're exploring off the coast of Brazil,
yep,
or off the west coast of Africa, or it makes much more sense, since they really become almost financial houses, to go out and buy existing reserves in the ground. The problem when they go out and make an acquisition and buy another oil company, you're really not bringing new reserves and new production into play. All you're doing is just consolidating the industry.
No, you're absolutely right, Jim. I mean, one of the things that we got to realize here is back when we had high-priced oil and high-priced natural gas, price alone was enough incentive to get people to go out and explore and bring new projects on. And the game was, how quickly can I get it to market? Now we're dealing with low-priced commodities. The price is no longer the incentive. So if we're serious about trying to become energy independent, when most of our infrastructure runs on the hydrocarbon of one kind or another, we need to get serious about maintaining these production levels. This doesn't do that. What this does is it causes companies to go, okay, well, now you've added 10% or you've added 15% to my costs. I've got to reduce my exploration budgets even further. So we've made it even harder. It's kind of like being a cigarette smoker, and they keep adding tax onto my cigarettes until I just can't afford to do it anymore.
Well, it's unfortunate, Richard, but when you have people even like Daniel Yergin from SARA warning, or the IEA warning about depletion. Here's another factor that we're not looking at, and that's the natural depletion rate around the world with these older oil fields. And depletion doesn't stop just because the economy isn't doing that well or we're in a recession.
Very true.
Depletion is relentless, and it gets worse as all of these older oil fields where we get most of our oil are aging. Most of these oil fields that they were looking at were discovered 50 and 60 years ago. So the giants are in decline, and when a giant goes into decline, it becomes significant because, a good example is right here in our backyard with Canarell, where it's projected by 2011, Canarell's production is going to be down to 600,000 barrels a day. That's important to us in the United States because we get over 1 million barrels a day of oil from Mexico.
But not for long. I think if I start looking at this, I wonder, all right, are we going to be honest with ourselves and say that the hydrocarbon, either in oil or in natural gas, is important to the energy independence of the United States? And if it is, we need to start doing something about it. If we honestly believe that we are going to provide for the energy needs of the United States, which is 100 quadrillion BTUs annually, if we're going to provide it from some other source, we better find that source fast, because we're actually dismantling the only industry we have that produces large quantities of BTUs. Jim, I think we could go on this topic forever, but tell our audience, if they haven't seen it, where is the Financial Sense?
Financial Sense, you can reach us online at Financial Sense, that's SENSE, all one word, financialsense.com.
I'm Richard Loomis for World Energy.
And I'm Jim Puplava for the PFS Group.
Thank you very much for watching. And to see other shows on Reality Check, come to worldenergy.tv, or you can also find them on the energy page of thefinancialsense.com. And thanks again for watching.